All right, well, welcome to Chapter 4, where we'll discuss some partnerships. And actually what we'll do is we'll go through a bunch of different scenarios together in this PowerPoint. So again, you can download the PowerPoint off of FOL. But I'm going to do a verbal walk through what that looks like. So in here, we will look at the different types of partnerships, how to form them, how to divide income or losses. And then we'll talk about some withdrawals, the little differences on financial statements, as well as how new partners come or other partners go, and what to do when you need to liquidate the organization. So partnership is a form of business where two or more people come together. You probably learned that in a previous course. And they own a business, all of the assets, liabilities, and they share in some agreed upon ratio, any gains and losses. And however, profits are taxed individually. There are many similarities between partnerships and sole proprietorships. So they are a legal entity. They divide profit and losses. If you're sole proprietor, obviously it belongs to one person. And the partnership has the right to own property for operating that business. Once a decision has been made to enter a partnership, you want to record the initial contribution of assets, any liabilities that the partners bring into the business, and that will determine the partners or owners' equity accounts. So to form a partnership, you might contribute just some assets, whether it's cash or otherwise, or you might have assets and liabilities, possibly from another existing entity. So in this example here, we have Jackson and Thompson. They agree to create a partnership. Jackson wants to put in, sorry, there's something flying around. Jackson puts in $20,000 cash, and Thompson puts in some cash and some equipment, which has a current market value of $10,000. So you can see on screen here that individual entries will be a debit to cash from Jackson with a credit to Jackson Capital for $20,000. The Thompson piece would be a debit to cash for $20,000, a debit to the fair market value of the equipment being $10,000, and a credit to Thompson Capital for $30,000. So we have a total capital contribution upon creation of this partnership of $50,000. Or some accountants or bookkeepers would do this as one journal entry. So you can see that on the bottom of the screen, where there's a total of $40,000 in cash and $10,000 in equipment being debited. Once they've agreed and written up the partnership agreement, which spells out how they work together, how they split assets, etc., then they need to record that initial entry. So we're going to do another example here. So let's assume Lee Wang and Kim Chow decide to form a partnership, and the book values of the contributions for each partner are shown on the screen. Lee's bringing in some cash worth $2,500, accounts receivable worth $5,000 and change, with an allowance for doubtful accounts of $890, equipment of $10,500, accumulated depreciation on that equipment for $2,000, accounts payable and notes payable for $1,240 and $5,000 respectively. Kim Chow is bringing in cash worth $20,000, a building worth $175, and a bank loan of $80. Now, they have an independent appraiser that comes in, and they determine that the allowance for doubtful accounts should be $1,200, that there's likely some other accounts receivable that are uncollectible, and that the market value of the equipment should only be $5,000, which if you look at Lee, he's got a current net book value of $10,500 less $2,000. So on this original list, it's a net book value of $8,500, but it's technically only worth $5,000 at market value. So to determine what the capital is of the two initiating partners, you look at Kim Chow, take the cash of $20,000, the building of $175, plus the bank loan of $80,000 being attributed to the new partnership. Kim's capital would be $115,000. Moving down to Lee Wang, capital, assets less liabilities, cash of $2,500, accounts receivable of $5,340 net. So if we go back for a second, we would have the, we'll get there in a second, $5,340 net with the allowance for doubtful accounts on the liability side instead for the calculation of $1,200 instead of netting those. The equipment with a fair market value of $5,000 instead of the net book value that was on the previous slide. Then the allowance as discussed, the accounts payable for $1,240, the notes payable of $5,000, to get Wang's capital being $5,400. To record this formation of the partnership, a journal entry might look like this. We have total cash debited for $22,500, total accounts receivable debited for $5,340, the equipment of $5,000 and building for $175. So those are our debit entries for the assets. The credit entries, you have the contrary account, the allowance for doubtful accounts being a balance of $1,200 credit, AP $1,240, notes payable $5,000, bank loan of $80,000, and then the two capital accounts being $5,400 and $115,000. So hopefully you add these up and they will show a balance. Some example exercises, which again, we'll cover some of those next week together. Now, looking at division of income or loss, partnership profit might be based, equally. Two partners split two ways. It could be a different fractional basis. It's an agreed upon ratio. Maybe it's 60-40, 80-20, 90-10, 100-0. Who knows? But as long as it's agreed and documented. It could be based on capital investments, or it could be allocated using some kind of allocation that looks at salaries that they're expected to earn, maybe any interest on the capital that they have contributed, and any remainder would be on a fixed ratio, whether it's 50-50 or another fractional basis. The law says if there isn't a partnership agreement, it's shared equally. So it's 50-50 unless it's documented otherwise. So we'll look at the first part is, in an example, we're dividing profits equally. So it's 50-50. Let's assume they earned $46,000 net income for the year. And to share it equally, we divide that by 2, being $23,000. To close out the income summary or the net income for the year, we've closed out all the revenue and expenses to the income summary account as learned in accounting 1100. So we would debit our income summary for $46,000 and credit both the capital accounts for $23,000. This is sharing the net income equally amongst the two partners. Now, if they have a ratio that says Wang gets 60% and Chow gets 40%, we would do the calculation accordingly. 60% of 46,000 is 27,600, and 40% of 46,000 is 18,400. You can see it on screen here. It would still be a debit to the income summary to close out the net income, 46,000, and a credit to the capital accounts for Wang and Chow for 27,600 and 18,400 as per the 60-40 split. Next example says, let's divide it based on the capital contribution of each partner. So let's assume that Wang contributed 20,000 and Chow contributed 80,000. So it provides a 20-80 split in this example. And they're entitled to the net income based on that contribution. So in this case, we take our $46,000 net income, same net income as our previous examples, but we take 20% to be Wang's portion and 80% to be Chow's portion. Again, journal entry at the end of the year would be debit to income summary 46,000 and a credit to Wang and Chow for 9,200 and 36,800 respectively. Now, let's say an example where it's the profits or the net income of the partnership are split based upon agreed upon salary that they're expected to earn out of the partnership each year, plus any interest allocations attributable to their capital contribution, and then the share of the remainder. And that share could be 50-50 or otherwise. So let's assume that the salary says that they'll get Wang will get a salary of 18,000, Chow will get a salary of 20,000. They would each get 5% of their opening capital balance, and then we'll do the distribution accordingly. So I've set up a table here that starts with the $46,000 in net income. We'll take out the two salaries, 18 to Wang, 20 to Chow. We'll look at the capital contribution, which we said was 20,000 from Wang and 80,000 from Chow initially. So a 5% interest allowance would provide Wang $1,000, 5% of 20,000. And a 5% of 80,000 would provide an allowance for interest to Chow of 4,000. That would leave us a remaining net income to allocate of $3,000. And we're going to assume in this example it's 50-50. So 3,000, 50% would go to each partner, being $1,500 to Wang and to Chow. So their closing equity, their change in equity for the year out of the 46,000 would be 20,500 to Wang and $25,500 to Chow, which totals the $46,000 net income. To record that journal entry, then we would have to debit the income summary for 46,000, and our backup document says the credit to the two capital accounts for Wang and Chow will be $20,500 and $25,500 respectively. Now, what if allowances exceed net income? So let's assume that net income was only 40,000 for a minute. But Wang's salary is 18, Chow's salary is 20, interest allowance was $5,000, and the remainder was a negative 3,000. So in this case, the first few steps are the same. We're giving 18 to Wang, 20 to Chow, 5% of their opening capital being 1,004. So we have a net loss to be allocated of $3,000. And it's allocated just like there's profit, 50-50 to each partner. So here we would deduct 1,500 from Wang and 1,500 from Chow. So our total change in capital for Wang and Chow would be 17,500 and 22,500 respectively. So in this case, our journal entry then would be a debit to the income summary for the 40,000 net income and a credit to Wang and Chow capital of 17,500 and 22,500 respectively. Now, another situation is the partners may withdraw cash or assets from the business throughout the year for personal use. On November 5th, 2020, Wang and Chow both withdrew $8,000 and $15,000 respectively. The journal entries to record those withdrawals and related year-end closing entries for the partnership are shown below. So when they withdraw the assets from the company, in this case, we're assuming cash, on November 5th, it would be a debit to their withdrawal accounts for $8,000 and $15,000 respectively, and a credit to cash for $23,000 for the total amount that they pulled out. At the end of the year, just like when you do all your other closing entries, you would have to close out the withdrawals account. So we'd want to credit Wang and Chow withdrawals for $8,000 and $15,000 and debit Wang and Chow capital for $8,000 and $15,000 as well. You can see that on the screen. All right, let's move forward to financial statements. So there are four basic financial statements that we've spoken about often. They are the income statement, the statement of partners' equity instead of owners' equity as partners, the balance sheet, and the statement of cash flows. The biggest difference in financial statements between a sole proprietor and a partnership is that a partnership has two or more people. So there's a little bit more accounting for equity, as you can see from the previous examples. So let's have this example again. We have Wang and Chow. We have their income statement for the year end 2020. Service revenue is 60, bunch of expenses, net income of 46,000. We're told that the partner share of income is divided according to the terms of the partnership agreement, and any detailed calculations for the distribution of profit or losses is included as a separate schedule and notes to the income statement. So here's an example of what the statement of partners' equity could look like. So we'll assume that on January 1st, it was nothing because they just came into formation in the year. They invested 24,500 from Wang, 80,000 from Kim Chow for a total of 104,500 in this example. We are assuming in this example net income is 50-50, so it's $23,000 each, plus any withdrawals. In this example is 8 and 15. So the total partners' capital as of December 31st would be Wang at 39,500, Chow at 88,000, for a total partners' equity of $127,500. So this schedule is created in order to demonstrate the change in the balance of the partner's equity from opening of 0 in this case to their closing specific amounts. Any changes in partner's equity are typically due to withdrawals or investments, and then obviously each partner's share of any profit or loss for the year. Sorry. All right. Let's look onto the balance sheet, what it would look like. So our assets on the left-hand side would look the same. We have cash, AR, equipment, and buildings, so our different long-term assets. Total assets of $220,000. And on the right-hand side, we would have our liabilities. And at the bottom, it would be called partners' capital. We'd have Wang capital and Shao capital. These can be in order of joining the partnership. They could be in alphabetical order. It really doesn't matter as long as they're listed there based on the partner's preference, usually. And in this case, we have 39,500 and 88,000. You say typically, if you're required to do an audit, you would typically do these in order of magnitude. So the largest dollar first, but that's just one example. Doesn't matter for this purpose. Okay, so the next few slides, we're going to talk about adding or withdrawing a partner. So the original basis for a partnership was a partnership agreement. When a partner leaves or another one's added, a new partnership agreement needs to be prepared. So it's a legal document. So you want something written down, signed off by each partner that identifies who's contributing what and who's how do you share profit and losses, et cetera, or what to happen upon death. The partnership does not need to open a new set of books, but they just need to make an adjustment to their current set. So the first situation we have here is an addition of a new partner. So they may want to add a new partner, and that usually happens through either investing assets in the partnership, or they might purchase part of one of the other partners' equity. So let's look at this example where there are 3 partners, A, B, and C, and they want to add partner D. So if it's as simple as partner D just wants to put $100,000 in, and it just changes, who's in there, there's no reduction or increase in the other partner's values, we would add the $100,000 cash from the new partner and set up a partner capital account. So the journal entry debit to cash and a credit to capital for the partner D. It's the most simple way, but it's probably not the most realistic. Let's assume that the addition of that partner, they purchased the equity of another partner. So in this scenario, partner A sold part of his equity to partner D. So partner A pulled out $100,000. Basically, partner D gave partner A 100 grand, and then we shift the equity between those 2 partners. To record this as a journal entry, you would debit partner A capital to reduce their capital in the partnership, and credit a new partner D capital for $100,000. So our total total partner's equity does not change in this case. All right, another situation we'll go through here is withdrawal of a partner. So sometimes somebody might want to leave the partnership. Okay, when they leave, their capital account is closed and they likely receive a cash payout. And the withdrawal of that partner may be payment from partner's personal assets, so not from the partnership, or it could be from the partnership. And we'll give a couple of examples. So this first situation, partner C wants out. Partner A and B use some personal cash, so they both have cash outside the partnership of $25,000 each, and they each give partner C 50 grand. Partner C's equity then disappears, and partner A and B's equity or capital contribution increases because they put their own money in theory in and then out to the partner C in one transaction. So for this, the journal entry, the total capital did not change, so it still remains 320. So we need to debit partner C's capital to get rid of it. And we need to credit partner A and B based on how much they each paid. And in this case, they both paid equally $25,000. What just happened here? Oh, okay, here we go. Another situation is where partner C was paid from partnership assets Maybe they took out, some actual long-term assets or maybe some cash, whatever that might be. We'll assume cash in this example. So partner C, which shows that we reduced their capital by 50 grand. They pulled out and they were given cash from the partnership accounts. So in this situation, the capital or the equity section of the business reduces. And the journal entry accordingly would be a debit to partner C capital and a credit to cash because the cash actually reduced from the partnership assets. All right, now, sometimes it happens that there might be bonuses to existing partners from a new partner, okay? So sometimes a new partner comes in and they agree to pay a premium in order to come into the business, and that's not uncommon. So let's look at an example here where we have the capital balance before any new partner for A, B, and C, and D is coming on board. It's 120, 150, and $50,000. Oh, I don't know why that popped up first. So after they negotiated a new partnership agreement, partner D agrees to pay $200,000 into the business, but only for a quarter of the share of the business's book value. So what you need to do is look at, okay, if I add $200,000, our total equity in the business would go from 320 to 520. Therefore, we need 1/4 of the 520 to be partner D's value. So you take the 520 times 0.25, your formula will tell you that 130,000 should belong to partner D. So partner D is paying 200,000 in cash, but they're only getting value of $130,000 in equity. What happens to the rest of the transaction? It's split to the other partners, and in this agreement, it was a third each. Sometimes it could be based on the opening capital balances. It depends on what they've negotiated. So in this case, $200,000 comes into the business, so it'll be a debit to cash, and then the capital accounts are credited accordingly. $130,000 to partner D, which represents 1/4 of the new capital balance, being $520,000, and then $23,333 each for the other three partners. There's a $1 rounding. That's okay. All right, let's assume the opposite happens, where there's a bonus from existing partners to buy in a new partner. And this could happen where maybe you've identified someone that you want to bring in that might add value to your organization more than just cash. They have more market contacts, they might have existing knowledge or clients or whatever that might add value on top of cash. So in this situation, a new partner provides $100,000 in cash, but we're assuming it's worth about $105,000 in value in this case. Okay. Sorry, just double checking. $105,000. So again, they've agreed that each partner would pay a third for that premium they owe the new partner. Okay, otherwise known as a bonus to the new partner. And the journal entry in this case would be a debit to cash of $100,000 and a debit to each of the capital accounts for the three pre-existing partners of 1,666. So therefore, the credit to partner D's capital is $105,000. So there's a little note here that the $100,000 contribution made by partner D increases total assets to 420. Okay. So that just provides a little more description of what we just said. Now, let's look at withdrawal of a partner. So partner C decides to leave and it takes $40,000 cash with them. So in this situation, if partner C had capital of $50,000 in value, but they only took $40,000 in cash and said, bye-bye, I'm moving on, we need to remove their capital of $50,000, but they only took 40 out. So there's a $5,000 bonus to the partners that remain in order to balance the transaction. So in this case, they took $40,000 out of cash credit, took $50,000 debit out of partner C's capital account, and then the balance is split $5,000 each to partner A and B capital accounts. All right, so sometimes there's a bonus to the old partner. So this is the opposite of the previous transaction. So in this situation, we have partner C. He decides that he will leave the partnership, but he has to take $58,000 with him. So the opposite of the previous one, we need to remove the capital, full $50,000, and then split the $8,000 as a reduction in the capital for the remaining partners. So this journal entry then would be a credit to cash for $58,000, the amount partner C is taking, a debit to the partner C capital to remove it of $50,000, and then a debit to both partner A and B capitals for $4,000 each. Another situation might be where the partners decide to end or sell the business. It might dissolve due to bankruptcy or some other reason, and this is known as a partnership liquidation. This process typically involves selling off any assets, paying any debts, and the remaining proceeds to any partners. So typically they follow a specific set of steps, which you can see on the screen here, where they sell off the partnership's non-cash assets for cash, and they might have a gain or loss in the situation. Any gain or loss to the partners according to the individual, they allocate the gain or loss to the partners according to the profit and loss ratios. They pay the partnership liabilities in cash, and any remaining proceeds are distributed to the partners based on the balance in their capital accounts. So we have a situation here that says before liquidation, ABC Partnership had assets valued at $700,000 and liabilities of $6,000. Therefore, their net assets were $100,000 for these three partners. Now, if the partners decide to sell the non-cash assets for $570,000, this represents a loss of $30,000. So if we go back for a second, the non-cash is just some land worth $600,000. They sold it for $570,000 is a loss. So the journal entry to record that transaction would be decreased land credit $600,000, increased cash $570,000 debit, and debit the loss on sale of assets of $30,000. So for our balance in our cash account would then increase to $670,000 from the original $100,000. So now we need to allocate the $30,000 loss equally among the partners. That's what the agreement says. So we will debit each of partner A, B, C capital accounts for $10,000 each, and we'll credit the loss on sale of assets for $30,000. So that moves that loss on the sale of land into their capital accounts because we're liquidating. Now we need to pay the partnership liabilities to all the creditors. We have a cash balance of $670,000. And we have two items on our liability list, if you recall from the previous slide. We'll go back for a second. 200 and 400, notes and accounts payable. Okay, so we need to debit those liabilities, 200 and 400 respectively, and credit the cash for $600,000. Now we have our remaining cash is then distributed to the partners, which will be the $25,000. So you'll see the partners, the remaining cash is now distributed to the partners, and their capital balances will also reflect the loss from the sale of the land. So we show $25,000 partner A, $30,000 for partner B, and $15,000 for partner C. So in order to distribute the remaining cash, it'll be a credit to cash of $70,000, which is the amount of money left in the partnership, and a debit to partner A, B, C capital accounts of $25,000, $30,000, and $15,000, which if we go back a slide, tie into what those general ledger accounts are. And now there's zero in all of the GLs. So a little summary of what happened here is before liquidation, they had cash of 100, land of 600, et cetera, across. So we sold our assets and realized the loss. So down 600 in land, up cash 570, and then the loss was split amongst the partners. We paid the partnership liabilities of 600. So now those three columns are zero. Then we take the cash of 70,000 and split it to the capital accounts. Therefore, all our final balances are zero for each account. Now, what happens if you liquidate and there's a deficiency? So many times you might sell off your non-cash assets, pay all your debts, and maybe you have a negative balance. So let's again, in this example, we assume they have assets of 700, liabilities of 6, and net assets equal to 100, but we can only sell it for $517,500, generating a loss on those non-cash assets of $82,500. So here we go. The right-hand side journal entry, then we'll record the sale of the non-cash assets, land, credit land, 600, debit cash, 517,500, debit the loss on sale of assets of 82,500. We'll take any of our cash, we have to pay 600 out to pay off our notes and accounts payable for 200 and 400. Now the 82,500 is allocated equally among the partners. So it's a $27,500 debit to each of the capital accounts. Just to record the loss and being that distributed among the partners. Now there's a deficit in one of the partner C's accounts. So if you recall, partner C's account had 25,000 in it. You take 27,500 out. Now they're in the hole in debt. Now sometimes the partner might be able to or might not be able to pay their debt. If they do, so the first example here, partner C has sufficient cash to pay, or two, the partner C does not have enough cash to pay. If they do have enough cash to pay, cash in the partnership would increase 2,500, and the partner C capital account would credit 2,500. So now their capital account is 0 at the end. So basically, they will get nothing out of the final proceeds that they had to pay in. Let's assume they didn't have enough, but we need to zero the account. We need to, first of all, credit partner C's capital account to get it back to 0, and we need to split it to the remaining partners. So we need to debit each of partner A and B's capital account by $1,250. And that's in order to cover the capital deficiency in the partnership. So partner C will still get no cash, but partner A and B basically paid for that loss for that third partner. Now what happens is they would now be able to close the partnership because they'll take what's cash left and split it to partner A and B based on their capital accounts. But after that, they might go after partner C to try to charge and get their money back. They'll likely sue them to get their money back if they had to contribute, or for $2,500, they might just say forget it and be done. So that's this chapter all about partnerships. Hopefully you found that somewhat helpful, and you take care.